Good morning, everybody, and welcome to our Breaking Breakfast seminar on the tax impacts of operating internationally. For those of you who don't know me, my name is Paul Goldwyn, and I'm a partner in the Financial Services Division at PKF Littlejohn, specializing in insurance intermediaries and heading up the firm's offering to the insurance intermediary market. I'm sure you will all agree that Brexit has caused many issues and challenges to the UK economy and also to the insurance intermediary market, particularly for those of you with EU business and having to find solutions to be able to retain this business post-Brexit. In the world of tax, however, as well as challenges, the Brexit environment has provided firms with a whole list of opportunities. And it is these opportunities and planning points that we are going to focus on today. We have assembled a top-notch team of speakers drawn from our tax department who will take you through the issues. We're kicking off with Tom Golding. Tom is a director in our corporate tax department and will look at the corporation tax angles of operating internationally, covering such areas as operating as a branch versus a subsidiary, the foreign income exemption, tax aspects of overseas branches, Brexit and withholding taxes, and aspects of research and development. Following on from Tom will be Louise Fryer. Louise is also a director at PKF, heading up our global mobility division. Louise will look at all the people aspects of operating internationally, and will also consider aspects of working in a hybrid environment, which, as you all know, is the new normal. Finally, wrapping up the seminar will be Luigi Lungarella, our VAT director. Luigi will in some ways take us back to basics, but will also incorporate some very valuable points arising from the opportunities that Brexit has provided, which could potentially lead to very favorable VAT outcomes for all firms. I hope you find our seminar useful and insightful, and without further ado, I will hand you over to Tom.
Good morning. If we can have the next slide, please. So when setting up overseas, there are two main options. Firstly, there's an overseas subsidiary. This would be a company incorporated in a jurisdiction overseas, set up as a subsidiary of the UK company, or perhaps a UK holding company. The other option would be an overseas branch. This would be an extension of the UK company overseas, most typically a fixed place of business in a different jurisdiction, such as an office, perhaps with some employees. There are tax differences with regards to these options. An overseas subsidiary is taxed locally at the domestic rate of tax. Profits repatriated to the UK as dividends are then exempt, or most often exempt from tax in the UK. As a result of this, the overseas profits will only be taxable at the overseas rate of tax. Where you have a branch, the profits attributable to that overseas branch are taxed overseas first at the overseas rate of tax. However, because these profits also form part of the UK company, they are then subsequently taxed at the UK rate in the UK. There is relief available against the UK tax. This relief is limited to the UK tax that would be payable on those same profits. So if you take an example where the branch is in a jurisdiction perhaps where tax is payable at 25%, those profits are then subject to tax in the UK at 19%. The credit available in the UK is limited to that 19%, meaning there's no additional tax to pay in the UK. What this essentially means is that the overseas profits of the branch are effectively taxable at the higher of the UK or the overseas rate of tax. As well as these direct tax implications, there is also employment and VAT tax consequences, which Louise and Luigi will discuss later. Next slide, please. There is one exemption when looking at branches. UK companies can elect for overseas branches to be exempt from UK tax. Where the selection is made, it is irrevocable, so cannot be reversed. It applies to all branches of the company. So if you have a UK company with multiple branches in multiple different jurisdictions, the exemption applies to all branches and it can't be done on a branch by branch basis. It does exempt both profits and losses. So profits won't be taxable in the UK, but similarly, any losses generated in these overseas branches cannot be relieved in the UK. Where a branch has been set up and has already generated losses, and these losses have been utilised in the UK, the exemption cannot apply until these losses have essentially been reversed. What this means in practice is that the exemption will not apply until that overseas branch has generated profits equal to those losses already utilised in the UK. There also can't be a tax avoidance motive, and for small companies, this is only applicable where the branch is in a jurisdiction that's got a tax treaty with the UK. Since its introduction, this exemption has not widely been used in the UK. The two main reasons for that are, firstly, it makes the UK tax return more complicated. The profits still form part of the UK company, but they have to be excluded when submitting your UK return. And because the UK rate of tax has been relatively low when compared to other jurisdictions, it has been of limited benefit. If the UK rate of tax is 19% and tax has been paid at higher rates in other jurisdictions, there should be full credit relief to avoid any more UK tax. Next slide, please. As some of you may know, the UK rate of tax is set to change from April 2023. It's currently at 19%, so fairly low down on the list. However, from the 1st of April 2023, this is set to go up to potentially as high as 26.5% on some marginal profits between certain bands. However, the main rate is set to increase to 25%. As a result, where previously there was maybe no benefit of electing into the branch exemption, there is now potentially a significant tax saving. Next slide, please. So what does this mean for you? When originally setting up an overseas branch, the foreign tax exemption may not have been considered in any great detail. Typically, where a new branch is established, it may generate losses in the initial years. If a branch exemption had been elected into, there had been no availability to use these losses in the UK against other profits. Similarly, as it's irrevocable, there'd have been no ability to claim future losses. And if the tax savings had been minor or non-existent, and it increased the complexity of the calculation, it's likely that these may not have been opted into. However, as I said, with the increase in UK tax rate, this potentially now provides a more significant tax saving from April 2023. Having said this, there are always other considerations that need to be taken into account. The overseas rate of tax may also increase. We've seen spending increase across all governments over the last 2 years as a result of COVID. This is likely to need to be recouped via tax in some way, so may result in overseas tax rates increasing. The UK rate of tax may not go as far as 25% or may not be permanent. The UK government has come under pressure from some areas to ensure that the UK remains competitive for business. As a result, it may not be that the tax rate does go as high as 25%, or if it does, it may not last indefinitely. There are also other considerations. I mean, if a future sale is planned of the overseas operation, it may give a potential exemption from UK tax on that future sale. Next slide, please. Moving on from corporation tax, where there are transactions cross-border, particularly interest, dividends, and royalties, there is almost always a need to consider whether withholding taxes should apply. When the UK was part of the EU, the parent subsidiary directive meant that any dividends paid between companies located in different member states were exempt from any withholding taxes. Similarly, there were directives that applied to interest and royalties, meaning that withholding tax would not be applied to these. In the case of interest, it was often that the rate could be reduced to 0. However, there was usually the requirement to apply for this rate, This was typically overlooked, and we have seen tax authorities in different jurisdictions challenge this, even when the rate could have been reduced to zero. If no application had been made, they can ask for the tax to be withheld and interest on any late payments. Post-Brexit, the UK is no longer a member of the EU. As a result, the parent subsidiary and other directives do not apply. This means we need to go back and look at individual tax treaties that the UK has entered into between each separate jurisdiction. In a lot of cases, these tax treaties may provide similar protections, potentially reducing it to 0%, maybe reducing it below the standard withholding tax rate. But it does need to be looked at on a case-by-case basis. Similarly to how the Interest and Royalties Directive worked as part of the EU, particularly where interest is concerned, there is often still a requirement to apply for the rate to be reduced. Again, this is typically something we see that's often overlooked. In addition, with PE-backed businesses, debt can often come from non-tax treaty jurisdictions. As a result, withholding taxes may be due on any interest payments that are made from the UK to these jurisdictions. With these non-tax treaty jurisdictions, because any income tax on the interest received is likely to be low or nil, then any withholding tax can become a pure cost, as there's no ability to claim any credit for this tax suffered. There are other mechanisms that can be used to reduce this exposure. For example, listing a debt, as any interest paid on listed debt is exempt from UK withholding tax. Next slide, please. Finally, with research and development, availability of R&D is becoming increasingly well known amongst intermediaries. This is a tax relief on innovation, and typically with intermediaries, we see it on sort of software costs, platform development, AI integration, algorithmic pricing, that type of thing. However, we do also increasingly see development teams being based overseas. Portugal, until very recently, the Ukraine, we're seeing increasing amounts of, and the Netherlands. The government again has come under pressure to focus R&D on genuine costs and innovation that is incurred in the UK. The first measure they've introduced is that there's a PAYE cap now on R&D relief. So relief is limited to a maximum of 3 times the amount of PAYE that's been paid in the UK. Now, typically with an intermediary business that's got an established base of UK employees, this wouldn't be a limiting factor. However, where you get a new startup R&D company, this can become a limiting factor. It was announced at the autumn budget that the government was looking at more ways to capture the benefits of R&D and make sure that they are restricted towards the UK. In jurisdictions such as the US and Australia and Canada, we see R&D or similar reliefs being limited to only those costs that are incurred in the UK being relievable. Last slide, please. So just looking at an example, for a small or medium company where there's qualifying R&D costs of 200,000, if the relief is restricted to only UK and those costs are undertaken in the UK, there'd be an additional tax relief uplift of 260,000. This would result in an overall deduction for UK tax of 460 at a rate of 25%. That would be a reduction in tax of 115,000, giving a net cost to the employer of 85,000. If that same R&D activity was undertaken overseas and there was a restriction on the relief that was available, for the same £200,000 of cost, there would be no additional uplift. So there'd be a total deduction of 200,000 with 25% corporation tax relief. That would result in a net cost after tax of 150,000 to the employer. So quite a significant change in cost if those activities were to be undertaken in the UK versus overseas, and if there was to be a restriction on the relief available. I think with that, I'll hand over to Louise.
Thanks, Tom. Yeah, I'm now going to talk to you about people. Now, Tom's talked you through the subsidiary and branch differences in terms of structuring your business, but there's also how you're going to populate those various entities and where you're going to bring the people from. So next slide, please. We'll look at subsidiaries and branches in the same way. You'll see that there are two categories for subsidiary here when we're talking about people. And we're really talking about the taxation of people when they're moving in between countries. And a lot depends on reporting correctly, whether or not you're set up as a subsidiary with a tax treaty, a subsidiary without a tax treaty, or a branch. So first of all, we'll take the subsidiary. The UK has a tax treaty with an group overseas entity, and you want to move some people around. They're not going to be formal secondments. They're literally just going to backwards and forwards for business purposes. Many companies don't see a problem with this. After all, it's business travel. But as with many things, it's not that straightforward. And depending on the countries that the movement is taking between, then you need to think about, are there any special reporting requirements? An example for this is in the UK, if you have people coming into the UK to work on a project short term, or meet with colleagues, undertake some training, anything along those lines, then the UK entity must have what is called an Appendix 4 short-term business visitors agreement. What this does is it allows the UK entity to take advantage of the tax treaty, and therefore those short-term business visitors may not be taxable in the UK. If you don't have the agreement in place, then the default position is a person comes for one day, they have to go on UK payroll. Every time they visit the UK, they have to go on UK payroll. So there's a lot of admin in terms of putting people on payroll, taking people off payroll, taxes withheld, that tax might not be due under the treaty. And so therefore that person then has to complete a UK self-assessment tax return to get the tax back. The short-term business visitor agreement simply means you take all of that admin away, you need to track your visitors and then submit an annual report to HMRC with the names and purposes of those visits of those people to the UK. Depending on how often they come to the UK, then you have to supply more and more information. Most people can come to the UK for between 0 and 60 days, and there are no tax consequences, but they must be listed. What happens if you have a subsidiary in a country, say, such as Bermuda, that doesn't have a tax treaty with the UK? In some ways, you might think this is simpler. There is no tax treaty, there's no agreement. Those people are in the UK, they're working, they're taxable. Again, you have the same conundrum around, okay, they're leaving, they're coming, they're leaving, every time on and off payroll. A couple of years ago, HMRC recognised the issues here and set up an Appendix 8 annual payroll. What this does is you track your visitors in the same way, and then you run a payroll in March to encapsulate all of the visits that they've had over the UK tax year. This is much more straightforward because you're looking at actual facts rather than estimates. There's no on and off payroll, it is just one payroll run. Again, this has to be agreed by HMRC in advance. But what happens when you've got visitors from an overseas branch? In much the same way that Tom referred to, the revenue will look at the branch as part of the UK entity. So ultimately, it's one company. If you're in the UK, you're working for a UK company, then there is that UK payroll requirement. So therefore, if you've got visitors coming from an overseas branch of a UK company, then again, it's payroll. You can also use the Appendix 8 annual payroll for these circumstances. Again, tracking an annual payroll in March, capturing all the UK days. Now, just a word of warning, none of these agreements can be used where people hold a statutory board position or if they're directors, but we'll discuss that a bit more later on. Next slide, please. So as well as your traditional branch subsidiary group setups, over the last couple of years, we've seen a real escalation in hybrid working and home working. And this has been escalated really as a result of COVID. A lot of companies have found that it works really well. So it's something that they wish to maintain. Now, if that hybrid working is in the UK and working time is split between working in the office and working from home, much in the way that we have a hybrid policy in PKF, where we have to spend 2 days in the office, but if we want to, we can work 3 days from home. There is no difference. We're still payroll, there's still UK tax, still national insurance employer, has the same reporting responsibilities. But what if home for an employee is a different country? They maintain their contract with the UK company, but they're a Spanish national or a US national, and they want to go back to their family home and work from there. Then that makes the situation much more complex. Interestingly, I was on holiday in Croatia last year, and there was a girl on the boat and she was talking to her friend. She was from the US, and she was saying that during COVID, she'd moved to London because she wanted to be with her boyfriend. The company didn't know where she was. Every time she had a Zoom call, she put a background on. So as far as they were concerned, she was still in the US. She thought that was absolutely fine. And her friend was saying, yes, you can work anywhere you want to. Isn't it brilliant? Etc. etc. Now, alarm bells rang for me, even though I'm on holiday. And I have to say, I didn't talk to her about it because she was on holiday. But ultimately, the fact that she has come to the UK, she's working in the UK, from her own perspective, she will have created a UK taxable presence and should be paying UK tax. But from the company's perspective, they now have a person working for the US company in the UK. So if, as I think, she was not a particularly senior worker, then they would have had a UK payroll obligation, most likely, but they wouldn't have necessarily had a PE in the UK. If she had have been a senior person, was signing contracts, making deals, all that kind of thing, then that is likely to contribute towards having a permanent establishment of the US company in the UK. So what for her was just a simple, yeah, I can work from where I want, actually is much more complex than that, and her employer really needed to know about it. We're doing a lot of work at the moment with companies that have people that went home to Europe over COVID, and the company might not have known that was the case, so we have to unpick and unravel that. We're also getting the other side of it, where companies are thinking about planning their policies, changing how they might work, and so they're coming to set things up correctly. Is it okay if this person works there? What are the company obligations? What do we have to do? So you've got both the retrospective and the future that we're dealing with at the moment, which keeps it all interesting. Next slide, please. So we're here today to talk about the social security and tax aspects, but I thought it'd be useful to put together a wheel of all the other things that a company needs to think about when it comes to using an international hybrid arrangement. It's not just social security and tax. You have to consider the risk elements. Central policies become even more important so that your HR team have something to refer to, so that employees are clear on what they can and can't do. Many companies are offering the international working to enhance an employee experience or attract talent in what is becoming a very, very tight market. Again, they need to offer that and be clear what they're offering. We briefly covered the company registration with the authorities, PE, and changes to group structure. Something that catches a lot of people out, and we don't offer legal advice, but we do bring it to people's attention, and that is the need for the company to comply with local employment law. The law applies where the person is working. So in France, for example, there are labour laws that are much more stringent than those in the UK. And a company who has a worker working remotely in France, even if they're a UK company, has to abide by those French labour laws. And it's the same wherever that person is physically present. There is also the additional cost to an employer, including visa costs. Again, that is a legal matter. It's something that, again, we are seeing more of as we left the EU. So now employees need a visa to work in the UK, and UK employers need a visa to work overseas. So again, more paperwork, more admin. Currency and exchange rate risk and bank charges. Are you still going to pay that employee in GBP? If you are you going to have a fluctuating salary depending on what the exchange rate is when you pay that person? Is that person happy to receive GBP? Do they have a UK bank account? Lots of things around the peripheral. And again, you've got the payroll obligations. Next slide, please. As I said, we are here really to look at the tax and social security. So very, very briefly, tax. The employable is liable to income tax in the other country, their country of residence, even though they're working for a UK company. Tax rules are based on where a person is physically carrying out their duties. So it's the location of the employee and not what they are doing that determines their liability to tax and which country has a primary taxing right. Doesn't mean there aren't reporting obligations in the UK for that person, but you have to think about the two countries. Social security is a more interesting one because whilst after Brexit, the employment articles in the tax treaties didn't really change, the social security agreements were drawn up under EU law. And so therefore, it was a much more complicated withdrawal. There is a withdrawal agreement in place, which the UK and the EU countries are supposed to abide by. But what I would say is at the moment, the UK authorities are having a lot of conversations with the French tax authorities or social security authorities, because although that agreement is in place and France signed up to it, they're having an issue over extending certificates of coverage for people that are on short-term secondment. So what happens there is a person goes on secondment, they remain employed by their home country, but they don't want to pay into local social security, so they continue their home contributions. So somebody going from the UK to Spain would remain in UK social security, not pay Spanish social security, but they need to apply for a certificate for them to be able to do that. The normal time is 2 years, but you can get an extension for up to 5. What France are doing is saying, fine, you've got a certificate, but we don't really want to extend it to the 5 years, so we're not going to. That is something that, as I say, is under discussion and may eventually come down to being human rights, but hopefully agreement will be sought before then. But that is causing issues for companies. Again, social security, you can't choose where you pay. It's a matter of fact. And social security tends to be paid where you're working, with the exception of the secondment arrangements. So it's not a choice. You pay social security in one country, and that is dictated by the rules that surround that. Again, back from the wheel, we've got payroll obligations, visas, sponsorship license, registration with the authorities, and all the additional admin that brings for the company and the advice that they need to get up front. Next slide, please. Now, this slide was put together before Ukraine happened, and it refers really to the repatriation of development teams to the UK. And Tom was talking earlier that, you know, a lot of companies have set up development teams in the Ukraine, in the Netherlands, because that's where the skills were, or that was just where it was more efficient to do so. Now, if those people were originally in the UK before they went to a different country to work, initially we would have been under EU rules and they would have been able to come and go as they pleased. But what if you're bringing that same team back to the UK now? If they're not UK citizens, then you have to get a visa for them to work in the UK. In order to apply for a visa, the firm has to have a sponsorship license. Without that, no visa. So again, it's putting more thought into the process, it's planning it, it's trying to make sure that things run as smoothly as possible, but additional time is required. When you're bringing somebody back, very often you'll have to look at their contract of employment and their terms and conditions. Do they need to change? We've talked quite a lot about the UK payroll requirements, so I won't talk about that again. You've also got the year when they come back to the UK, and that has its own special rules as well. Many companies offer an incentive to an employee to move, so it might be they give them a bonus. Even if that bonus is paid before they come back to the UK, because it relates to the UK, it's an incentive to make them move here, then that will have UK tax and national insurance consequences. This point was added in terms of what happens where individuals are unexpectedly repatriated. Now, this isn't something that is at the front of people's minds. It won't be, it shouldn't be, but it is something that's going to rear its ugly head at some point in the future. The last time this happened was when the oil workers had to evacuate. I had one client who was living on a beach for a week or two until he could get a boat back to the UK. They weren't planning to come to the UK, they just headed for the first safe space they could get to. HMRC took the view that whilst these were exceptional circumstances, they weren't exceptional circumstances. So exactly the same rules applied. They can be in the UK for 60 days. If they're here any more than that, then there are employer and employee regulations that have to be fulfilled. I would be very surprised if the revenue extend that special circumstances rule or anything else. So one to have in the back of your mind. Next slide, please. Earlier on, I mentioned non-resident directors, and they have a set of rules all to themselves. So there aren't the same rules around residence and payment and all the other things that we've talked about earlier on. If those non-resident directors of a UK company come to the UK in their role as director, they have a UK tax obligation. There is no relief, there is no get out. You cannot use either of the treaty agreements that we talked about earlier, and HMRC will not accept that a director's position is unremunerated. They see that a director has a senior role in the company, he has the power to make decisions, and very often is part of a board who control the direction of the company. So it's a UK company, that director is fundamental to that company, so therefore they want their tax on it, on any income that they have. Essentially, there are two options. You can carve out the director role if that director is also an employee, put a sum against it and put it through UK payroll. That happens every year, job done, and no further action is required either by the individual or the employer, so long as the individual doesn't have any other UK source income. So you need to have a conversation with your directors, essentially. The alternative is where you apportion salary according to the time spent in the UK on director duties. If a person has a contract, it cites a sum of money and that is paid, but the individual comes to the UK, say 2 or 3 weeks a year, then the UK will be looking to tax 2 or 3 weeks worth of their total income. So any share awards they have, any bonus they have, any standard pay they have. That is more complicated, and the individual will need to complete a UK self-assessment return because things might be slightly different. There might be, other things that they need to declare. Company still has to put that payment through payroll. You can get, again, special agreements and arrangements with HMRC so that you're not taxing 100% of income in the UK and 100% of income overseas. So you can apportion it, but you need to have that agreement. Social security rules are also different, and they are special. It's a special concession for non-resident directors if they visit the UK for a certain number of times and they're not here for, they're only here overnight, and or if they come for 1-2 week period a year. Again, that is a concession. You don't have to apply for it, but you have to have the paperwork to back it up. The alternative here is the individual can apply for the certificate of coverage from their home country, slightly different to the one for secondments because it's a multi-state and that person has to work 25% in their home country. But it's very rare for a non-resident director to pay UK social security. Okay, next slide, please. Here are some key questions that I'm going to leave you with. These are questions that will hopefully get you thinking, and the answers lead you to a point where you think either you need to take advice or you know what you need to do. So I'm not going to go through them today, but please don't hesitate to get in touch if you want to talk some of them through. So now I'm going to hand over to Luigi, and Luigi tells me that VAT is the sexy tax, but I'm really not sure. Luigi?
Well, Louise, I'm very, very confident that I can prove that what you have just mentioned is right. Just give me 15 minutes or so. And you have heard about business tax. You have heard about issues affecting internationally mobile employees. But as Louise just mentioned now, also VAT can be a key obstacle to trading for all international businesses, whichever the sector they're involved in. And brokers, and in particular those trading with Europe, have a real problem in relation to VAT. And I work with a number of organizations like yourselves. And what I want to do with our time today is to provide you with an update on recent developments that affect brokers trading internationally, to share our experience or what we find are common problem areas, and to give you some ideas of possible solutions and opportunities that you might be able to use within your own organization. And what we tend to find is that these are the main topics that are affecting brokers, and they are all very much interlinked with each other. A key starting point is to be comfortable with the liability of supplies. This is very important. This is key, of course, as it determines whether you need to charge any VAT to your recipients, which ultimately will lead to the payment of output tax to HMRC. Now, looking at those of you that are in the audience today, the core of the majority of your businesses is exempt in nature, but based on what I know about your VAT accounting, I think that the majority of you have also got some standard rated outputs, and the VAT liability of your supplies is also key to ascertain how much VAT you can reclaim and how much might actually end up being restricted. And let's not forget that the greatest amount of brokers that are registered for VAT on a compulsory basis are actually registered as a result of the VAT liability of the UK activities. But the matter of liability of supplies should actually not be looked in isolation. And ascertaining the place of supply of services that you provide is also of paramount importance. Let's not forget that even if your supplies are exempt in nature, they would lead to input VAT recovery when the place of supply of those services is outside the UK, or at least this is the position after the end of the Brexit transition period, as prior to the 1st of January 2021, the relevant territory was anywhere outside of the EU as opposed to anywhere outside of the UK. But based on my experience of reviewing the VAT position of brokers, I believe that brokers often tend to find the place of supply analysis fairly challenging. So is the place of supply driven by the location of the private individual? Or is the place of supply driven by the location of, the recipient of the services? Or is it driven by where the underwriter belongs? or is it linked to the location of the risk? And is this place of supply in line with the insurance premium tax considerations? All questions that I tend to find often catch brokers out. And another question to ask ourselves is whether you are purchasing any services from overseas. You might think the supplier has not charged any VAT, neither UK VAT nor VAT from overseas, so it does not affect my VAT position. Well, that might be an incorrect assumption. In certain cases, you might be obliged to self-account for VAT through the reverse charge. And if you're not a fully taxable trader, that might not be just a simple in and out transaction. So there will be an irrecoverable VAT cost resulting from the application of the reverse charge. And purchasing services from overseas might also result in a compulsory VAT registration when the value of the supplies exceeds the VAT registration threshold. I was speaking with a broker recently who was not registered for VAT and thought that it was correctly not registered for VAT as a result of making solely UK exempt sales. But what we discovered is that that broker had a liability to register for VAT retrospectively as a result of purchasing services from overseas. And that was a rather expensive adjustment that needed to be carried out. And the topic of the application of the reverse charge is also interlinked with that of the liability of supplies. And that is because when you're purchasing services from overseas, you must establish what is the correct liability of the supplies that you're acquiring. For example, a new client of ours had been assuming that all the services that he was acquiring from overseas were due to be self-accounted, adopting the standard rate of VAT. We carried out an analysis and found that the sum of these services would have benefited from the UK VAT exemption, meaning that they could actually go back 4 years and carry out a retrospective adjustment that resulted in a considerable repayment from HMRC. And then let's not forget about the Brexit effect on recovery rates that Paul mentioned earlier on. We're looking at the Brexit glass half full here, and the majority of you can benefit from much increased recovery rates as a result of the termination of the transition period and the fact that the brokerage supplies to EU recipients can lead to a full input VAT recovery. And let's not forget that this was not the case prior to 2021. And in order to appreciate how all of these matters are interlinked, it is important to just take a little step back and appreciate how we work out whether a supply is chargeable for VAT, and if it is, how much VAT we actually charge on that supply. Effectively, we can say that there are 3 types of supplies that can be taxable, that can be exempt, or that can be outside the scope of VAT. And when it comes to taxable supplies, they can be standard rated, and as we mentioned earlier on, good amount of brokers actually are making taxable supplies, standard rated supplies. There can be management services, there can be a number of different recharges. There is a whole variety of standard rated supplies that you need to take into consideration. They can be subject to VAT at the reduced rate, and that's fairly rare for brokers, or they can be zero rated. And there is a whole list of zero rated supplies in the legislation, and there is also a list of exempt supplies in Schedule 9 of the VAT Act. But what you tend to find is that nowhere in the legislation there is a list of standard rated supplies. And in order to ascertain the VAT liability of your supplies, or the supplies that you actually buy from overseas, let's not forget this point. You just have to run through this order. Bear in mind that there is no list of standard rated supplies in the legislation, which means that basically you get there by default. And now we're going to have a very quick look at the Schedule 9 exemption. And Schedule 9 of the VAT Act provides a list of exempt supplies and of exempt items. Essentially, these are 15 groups, and each group is a specific exemption. For example, group 1, land. If you're subletting part of your building, that would normally be an exempt supply, and that exempt supply might actually have a cost, in particular if your landlord is charging VAT to you and you're subletting part of that building without opting to tax on that property, then that is an exempt supply, and there will also be an input VAT restriction on the VAT that your landlord is charging to yourself. Then broking is part of the insurance chain and therefore falls under group 2. And then we have group 5 as well, which is finance. And it is because of groups 1, 2, and 5 of Schedule 9 that most of the organizations are partly exempt and suffer input VAT restriction. And for many brokers, partial exemption is the subject that causes very, very, very significant challenges. And a broker that makes some supplies that are taxable or even outside the scope of VAT with input tax recovery, and by this please read non-UK commission, and some that are exempt, is classed as being partly exempt. And this means that input tax is restricted so that it is only claimed in relation to taxable activities, so non-UK commission. Now, this example just outlines that we have our broker, fairly simple broker, that makes taxable supplies of 1 million and exempt supplies of 4 million. Of course, this broker incurs some expenditure, and there is £150,000 of VAT on expenditure that is directly and immediately linked to taxable supplies, and that amount is recoverable in full, never mind what. And £600,000, which is directly and immediately linked to exempt supplies, so wholly attributable to exempt supplies. And that, I'm afraid, there is nothing you can do. That's just irrecoverable. But then this broker, just like I guess the greatest majority of you, also incurs some overheads. That can be audit fees, rent, you name it, just items of expenditure that you cannot attribute solely to neither exempt nor taxable activities. And the whole question mark over here, when it comes to partial exemption, is how much of that £250,000 you can actually reclaim. And adopting a very simple standard turnover-based method, what you do is that you're just taking a ratio of taxable turnover over total turnover. In this occasion, our broker has got a 20% recovery rate because 1 million is 20% of 5 million, which means that it will be able to reclaim 20% of that £250,000, which is £50,000. So overall, they can reclaim £200,000 precisely, which is the amount that is directly and immediately linked to taxable supplies, and that portion of the overheads, meaning that £800,000 will not be recoverable at all. But there are many situations where the standard method gives an unfair result, and the broker has then the opportunity to request a special method calculation. Now, this might be because the standard method of apportionment does not give a fair fraction. Now, to recap, generally, the standard method applies by default. If a trader is partially exempt, then they should apply the standard method unless a special method is agreed with HMRC. Now, it is fair to say that the majority of brokers have approved a special method with HMRC, as the standard method is unlikely to provide a fair and reasonable result. And over here, you can just see a list of very, very basic methods that can be adopted by partially exempt businesses. Now, these are obviously very simplistic, but they just give you an idea of what can be agreed with HMRC. In practice, special methods can be quite complicated. Every business, every broker is different, and they have their own peculiarities. So to recap, one can be fairly creative when designing a special method, as long as it can be proven that the standard method would give an unfair result. The difference in the outcome between a standard method and a special method could be very significant, such as, for example, I've recently worked with a broker. They were applying the standard method. The recovery rate was 18%. And as a result of the agreement of the special method with HMRC, the recovery rate actually went up to 34%. Therefore, it almost doubled. But let's always forget that this percentage only affects the overheads. So the middle bit in the example that we had a look at earlier on, and not the directly attributable input VAT. And there are several ways in which you can enhance your recovery rate. But the first step to take in order to do so is to carry out a full VAT assessment. This will allow you to analyze the VAT liability of your supplies. It will allow you to analyze the VAT liability of the services that you are acquiring from overseas. It will allow you to ascertain whether you should be registered for VAT, and if you are, to ensure that you're charging the appropriate amount of VAT. And another outcome, if you're not currently registered for VAT, could be that you might be able to do so on a voluntary basis. That is, of course, the easiest way to enhance your VAT recovery position and to minimize as far as possible your VAT leakage. But there are so many other ways, and many of them are simple solutions. The low-hanging fruits. For example, that business that I mentioned earlier on, that broker was purchasing services from overseas and assumed that these were liable to the VAT at the standard rate when applying the reverse charge. Well, they ended up saving in excess of £200,000 as a result of carrying out a simple analysis of the VAT liability of those services. It is important to look into possible opportunities, and there are tons of them, in particular after the end of the Brexit transition period. There are several potential added VAT recovery opportunities deriving from the changes that took place in January 2021. And that is in particular if you're making supplies to recipients based overseas, based in the European Union in particular. And then we have spoken, of course, about the low-hanging fruits, but there are some fruits that require a little bit of effort. And I would be lying if I were to tell you that devising and agreeing a new special method with HMRC was a simple job, but it's an exercise that can make quite a bit of an impact. Although I would strongly recommend, firstly, going through the 2 steps above. So to carry out a VAT assessment and also to look into some simpler ways to minimize input VAT leakage. And we have a number of practical examples covering all of the points above. And many of these examples show clearly how all the matters that we have discussed during the past 15 minutes or so are closely interlinked. And there is one that I was recently discussing with Mark Ellis, who joined our team last month. I think it's a lovely illustration showing how a small investment of specialist time can save money, can save reputation, and can save jobs. Over to you, Mark.
Thank you, Luigi. So the example happened about 6 weeks ago. So this was a foreign business that had bought a UK broker about 10 years ago, and it wasn't VAT registered at the time, and still wasn't by the time now that it was trying to sell the business. But the tax advisor acting for the purchaser during their due diligence had picked up on the fact that perhaps you should be VAT registered for VAT, and you should have been for the past 10 years, because they'd been receiving services from the parent company straight after acquisition 10 years ago. And they were calculating this reverse charge VAT, UK VAT, that was owed, that Luigi spoke about earlier. So the estimate was around £2 million of VAT and penalties, and that was causing a problem on the at the 11th hour in the sale process. So I was parachuted in to help on a call like this. It's just a half-hour call. This first thing we looked at was, are those services coming in VAT exempt services, which is where the client was at. Surely it's VAT exempt. We're in the world of insurance. And I had to say no. Just because you're in insurance doesn't mean that everything you do is VAT exempt. This is kind of back office support, for want of a better word, which is VATable. So we didn't get there anywhere with that. But then I asked them, do you supply services to overseas businesses? Which is, again, what Luigi touched on before. Those are called specified supplies. They're good. No VAT on the way out, but enables you to recover VAT on your expenditure. And they said, yes, about 80% of our income is derived from overseas businesses, which was music to my ears. So now I've just reduced their net VAT owed, because they'll be able to reclaim the VAT they pay under the reverse charge, 80% of the VAT of that VAT paid, which also helps to reduce their late VAT registration penalty as well, which is a percentage of the net VAT owed. And then I went a stage further and said, have you been incurring lots of UK VAT for the past 10 years? And they said, yeah, we've had an office refurbishment in that time and spent a fortune on an IT system. I said, how much is that about then? What if you could get 80% of that back? And they worked that out. And that managed to swing them into a £1 million repayment overall, with no penalty for that, because you've shot yourself in the foot by not registering for VAT earlier. So there's no penalty for late registration in those circumstances. So it was a very pleasant outcome. They were debating, what would it would do to the price with the liability to start with. But by the end of a half-hour call, we were at the position of them being very happy to say, well, who's going to get that saving then? Should we be increasing our price that we're selling for now? So that was a pleasant outcome. It's not always that way, but the trick is to take advice, as Luigi said.
Well, thank you. Thank you very much, Mark. And I think that this probably is the last point that we can make during our allocation of time prior to just going back to Paul.
Thank you, Luigi. Hello again, everyone. A lot of food for thought, and certainly many potential opportunities for all of your firms, particularly in the VAT area, as explained by Luigi and Mark. I do hope you found the seminar useful today and relevant as you expand your operations internationally and also deal with all the various challenges and opportunities that Brexit has posed. I certainly know from all of my clients in the audience today that there's quite a few issues there that need addressing. So please don't be shy. Feel free to reach out to our team. Contact details are in the pack, and Tom, Louise, and Luigi and Mark will be delighted to help you. That concludes our formalities for today. Thank you all very much for listening to our webinar, and have a good day. Thank you.